welcome to the podcast, everybody. It's the weekend edition. It's December 14th, Saturday, and Christmas is coming, and obviously the volume is going to get thinner and thinner and lighter, but we've been going through a little bit of pullback the last few days, and you know the stock market this time of year generally gets a little weak right now, and then you have a strengthening up through the end of the year. So given the fact that we've had, several down days in a row, it wouldn't surprise me to see the stock market have one last thrust through the end of the year, and I think that's highly likely. So let's first look at the S&P 500. You can see it's starting to roll down here a little bit, but I've drawn this line because what happened was we obviously were in this little channel, and stock market was doing just fine, kind of going to the bottom end and going to the top and back and forth, and this pattern continued, and then it broke out of that and we went to a new level, and now what we're simply doing is coming back to the top of that. So again, given the fact that we've had pullbacks that have, you look at this area right in here, we had 4 days that were pretty nasty. We had a few down days here, a few down days in a row here. But generally speaking, every time that's happened, buyers have come back in, and we've had more up days than down. And I think we're setting ourselves up for a rally into the end of the year. Now, there's a lot of, I think, confusion right now. The Fed's going to taper. The Fed's not going to taper. Ben Bernanke is going to start tapering before he leaves to clean up his mess that he created, or he's not, right? We don't know. And data comes out, economic data, and we had a lot of it this week. And it comes out and it shows that, they're going to start tapering. Then it shows they're not. Remember what happened earlier in the week. A lot of people were surprised. We got a budget deal, right? And Kumbaya up in Washington, and it was a very small budget deal, but a lot of people thought it was symbolic that Democrats and Republicans can actually get along for once. And so what happened was when the budget deal came out, what did the stock market do? It immediately fell. And why did it fall so much? It fell because part of the reason that the Fed didn't start tapering back a couple of months ago, at least this is the speculation, is that they didn't do that because of the government shutdown. They didn't want to be tapering at the same time there's a government shutdown. And what if the shutdown would have lasted for several weeks, months, etc.? And so given that, the Fed delayed. Well, now that we have a budget deal in place, and it's going to take us through a couple of years potentially, even though it's small, the Fed is now free to begin tapering back their purchases. We'll see. Again, you get this data that comes out yesterday or earlier in the week. You saw some inflation data that was worse than expected, meaning inflation was actually, there was deflation, so to speak, on some of the things that the people that make the products buy. And we also saw a big jump in the initial jobless claims. Remember, those are the people filing for unemployment. That thing spiked up. Now, I like to look at it over a multi-weeks and kind of take an average of it because there's some distortions. They always come back and revise the numbers. They blame it on weather. Maybe California didn't submit their numbers in time. All these different nuances, we'll call them in a polite term, basically make that number kind of jumpy at times. But it was higher than expected, which is a bad thing. It means, well, if the economy is getting weaker, then certainly they shouldn't be tapering back. Again, that's the perception. I'm not saying they should be doing that, but that's the perception. So you're getting this mixed data coming out. You're seeing some retailers say some poor things. You're having the initial jobless claims jump up. So given all of that, there's this tug of war. There's this back and forth, this uncertainty surrounding that. And so the stock market is meandering, and you can see it in the choppiness here. We haven't gone anywhere. If you look at the price, we haven't gone anywhere since back over here, which was October 30th. So we're pushing on 2 months of a sideways market. And again, I think I would love to see good economic data come out, the market actually go up. And we saw a couple of days like that. I think this was the day that happened where we saw a good jobs report. The market actually went up. That's how it's supposed to work. We're so used to right now when good data comes out, the market goes down because people are fearing that the Fed's not going to support the market anymore with their quantitative easing, which is ridiculous. But that's where we are. But here we are technically, and we've pulled back a little bit, and we're getting some mild oversold indications that what we watch. It's not extreme. It's not where you would go in there and say definitely, but you're getting to where, if you had way too much cash, you should go in there and buy some things. And yesterday, for the most part, was a pretty good day overall, simply because of the fact that there was a lot of stocks that did very well. A lot of them did very well. So, but here we are technically. This is an area we're going to bounce. If it does not do that, you're going to see, they call them air pockets, and we saw some where basically the market's going and it breaks through some levels and it just falls very, very fast because there's just no supporting bid there. But here's what I would be looking at. If we break through here, obviously the blue line's the 50-day moving average, which is hasn't been too significant, right? It broke down and back above it here and here and here and here. So the 50 isn't really been a big deal with the S&P 500 itself. But once you break down below that, you have to be looking towards, down to this red line again over time. And that's just because, again, keeping within the pattern. But I think we're going to bounce sooner than later. So let's watch that as we enter into the last few weeks of the year. All right, so fear. We show this all the time. It's the fear indicator, the VIX, the volatility index, and we got these spikes that have been buying opportunities all year long, and we're heading up. Again, where's the place to buy? Where's the easy buy? I guess you would say it's up here in the high teens. If the VIX comes up here and then starts to abate and head back down, that's your buy time. That's the time that you say, okay, I'm going to buy this thing. I've been waiting on it, because at that level, the S&P will be much lower. So watch for that to see if the volatility continues to pick up. Keep in mind yesterday, and it wasn't a strong day by any means. Actually, the S&P was negative on the day. The Dow Jones was only plus 16. But you do have small and mid-cap companies up about 1/3%. And the VIX was still up on the day. So watch that. Here's interest rates. And back over here, we've been saying that they seem to be wanting to push higher. And that's exactly what's happened. So, again, in our income strategy, we're short the bond market, meaning we're betting on interest rates going up as a hedge against some income-producing assets we own. And it's been working out nicely because this has been going up. And as I pointed out, it's not going up at the same trajectory it was back over here. But it looks like a foregone conclusion that we're going to push up against these old highs of 3% on the 10-year Treasury. And I think that's going to happen. And so this is kind of went up, rested, and now we're heading up and breaking down. And then what's going to happen is as we go through 3%, 3% will become the new floor. It won't go below that unless there's, again, some significant weakness in the economic reports that we're seeing. So again, watch the bond market, because the bond market, which is still negative on the year, and that's I'm going to talk more about it in future podcasts. But when you go to allocate money, there's always this discussion of how much stocks versus bonds should you have. How much stocks versus bonds? How much risk versus non-risk? Well, both those things are risky at times, and both those things are not risky at times. But I think that's a horrible way to look at it. I don't think it's a matter of how much stocks versus bonds. I mean, there used to be the old adage, well, you take your age and you take away 100 minus your age, and that's the percentage of stocks you should have. So if you're 75 years old, you should have 25% stocks and 75% bonds. Well, you would have a negative year this year because you would be down on a lot of bonds. Municipal bonds are down, TIPS are down. So you can't look at it as bonds versus stocks. I look at it as how much can you afford for drawdowns, meaning the account falling, and also how volatile is the portfolio going to be, and what are your goals? What are you trying to achieve? People that live off of income can't afford to see big drops. Well, if that's the case, they really can't afford to have too much in the stock market, because 2008 was a perfect lesson for that. So we'll talk about that more in future podcasts about allocation, and it's not really about stocks versus bonds. Now, let's take a look at gold. Gold's been acting very weird lately, which it's had a horrible year, and it's you read the headlines and it shows the lowest inflation. Taking out the financial crisis, the lowest amount of inflation in 55 years. So gold should be falling. But you're even seeing some bears at this point start to get bullish on gold. It's trying to get off the floor here. You can see this is the ultimate low, and this is the GLD. But it bounced off of it. We came back down, and we're kind of, kind of scraping the bottom here in this area. But it wouldn't surprise me to see gold rally up through actually after the end of the year. I think you're going to see some things that have performed very poorly rally in the first quarter, and the things that have performed great this year sell off in the first quarter. That would not surprise me one bit, and gold would be one of those things that could rally, and you could get a sharp rally. It could just be a trade, but start to look at it. I've mentioned this before, that we want to see if this picture starts to shape up like Apple. And if you look at the moving averages with Apple, what happened was, this thing was going down, and now what you're seeing is it kind of start to move sideways. Very volatile, right? It's doing this, but it's still overall moving sideways from point to point. It's at the same level it was back in June, as opposed to you go to June and say, what was the level 6 months before that? It was quite a bit higher. So we're starting to see it flatten out a little bit, and I think you do want to prepare for inflation at some point. I think we would hope for a little inflation at some point, and I think you need to start looking at some of those assets and what would cause you to buy some of those assets, because when it does come, it's going to come fast and furious as far as not necessarily inflation, but the securities that benefit from inflation will start to price it in very, very quickly. All right, let's take a look at oil. Oil bounced off this technical area we had drawn here, and had a nice bounce. Pulled back this week. It's sitting at $96.50 a barrel. Now it kind of looks like it's just meandering. Obviously came up to the 200-day moving average and couldn't get back above it, but I suspect that it'll probably move a little higher. Let's go through a couple of sectors. Financials do look good. It's one sector that I am long. And you can see here it kind of broke out. It's been very strong, and it makes sense. I mean, a big portion of financials are banks, and with interest rates going up on the 10-year Treasury and staying at almost zero on the short end of the curve, the spread for banks is widening. So pure traditional banking is doing very well, and so it's starting to do better, obviously. So financials, banks being a part of it, are doing well. Some of the exchanges are doing well. So you can see that financials broke out, and almost like the S&P have come back down. They were actually up a little bit yesterday, but on heavier volume, so kind of a churning around, but it looks like they could be poised to break out. And again, all the moving averages still moving in the right direction. Let's take a look at retailers. You've been hearing some interesting reports out of retailers lately. You're seeing some of the high-end retailers having some cautious things to say. So is it a matter of they're losing the high end, or is it that some low-end people shopping at high-end places? When I say low-end, that doesn't mean bad people, just low-end meaning on the economic scale as far as the income that they make. But those people tend to shop at places like the Walmarts, the TJX, Ross Stores, Dollar Tree, those things, as opposed to Tiffany's, etc. And so retailers have been struggling lately, and that'll be real interesting to watch, simply because, again, you got this kind of this breakout level, and the retailers have come right back to the 50-day moving average, so they look poised to bounce. They were up a little bit yesterday, but when you have this many down days in a row coming into what I still think is going to be a good holiday season, when it's all said and done, you're going to get a bounce off of this. So watch the retailers over the next few weeks. If we take a look at healthcare, healthcare had been on a roll and is now coming back into the original kind of trend it had been in. So again, the S&P could do the same thing where it comes back in here and settles in somewhere in here, but healthcare is kind of getting a little weaker. So as the Obamacare site was having issues, you'll notice that healthcare started to do extremely well, right? The Obamacare.com, healthcare.gov as it were, is down. Healthcare stocks go up. They start to fix it, and down we go. So just a little joke there, but actually it looks a little true. Metal and mining. This is an area that had been, let me zoom out and make a weekly picture, and you'll see the area beaten up severely. This basket of metals and mining stocks, $77 a share, went down to the 30s, so basically cut in half. And now you're seeing it's getting a little bit of life here recently, and obviously needs to break this bigger downtrend to get really going. But if we zoom in a little bit, they've been performing well since July. I mean, this was at $32, and it reached $41. So that's a 33% jump since the summer. So you've been seeing a lot of that. We've been hearing very bullish things in the coal industry. Obviously, natural gas has been going up. So you're starting to see, obviously, natural gas is not metals and mining per se, but you are starting to see some of the commodity stocks perk up a little bit. Energy stocks, metals and mining, natural gas prices. The Baltic Dry Index is actually going up. So you're starting to see all this stuff do better. And is it that fundamentally it makes sense, or is it that people are, again, positioning themselves for the inflation trade coming up? And again, we'll see over the next few weeks and months. Take a look at the home builders. Obviously very interest rate sensitive. We're having a nice run. Looked like they could do no wrong. And then they got beat up pretty good once the interest rate started to rise. They fell somewhere about 25% or so. And now they started to bounce a little bit. So watch these because they're setting up for either a breakdown or a break up. And usually when you get to the end of these little wedges, you tend to break down, not up. So if interest rates keep rising, you could see home builders start to pull back a little bit. And again, if interest rates methodically move up, there's other things that should do well in that environment, and home builders may not be one of them. It's not that they would do awful, but they will probably do just exactly what they're doing now, which is go sideways. So the easy trade in home builders may be over when the rates were falling. Aerospace and defense, which has been extremely strong, continues to be. Here's the trend it's been in. You can see it was in another trend earlier in the year, and now it's at a different trajectory. So watch for this to break. If it does, then again, have to move on. But for right now, it's just at the bottom end of this. If it bounces off of this, obviously it'll make new highs. Here's technology stocks, and you can see technology again broke out doing very well last 3 days. Got hit really hard. Part of the technology going up obviously is Apple has resurged, but I think you're going to see potentially a little more weakness, but this has been a strong area all year. I mean, this has been the place to be, has been technology. Some of the go-go stocks have been hit lately too that have been on a run, and so that's why you've been seeing some of the technology pull back. But again, I would say look for the 50-day moving average on this one, which is the blue line. That would be a nice spot for this to come down to and bounce, and then up we go. Energy is XLE, and you can see something that's happened here, and I've drawn a few lines, but it was in this big channel, right? And now it's getting a little bit tighter. We're at the very bottom end of it here. So again, watch for this because it's at kind of a inflection point. Either this is going to bounce off here, and that's where you should be buying, and put your stop somewhere right in here, or it's going to break down, and then obviously the 200-day moving average comes into play, which is that. And so watch that. The momentum may be slowing down a little bit on the energy sector overall. Here's consumer staples, and you can see they had broken out. They were making lower highs, and they broke out, and they've pulled back to their 50-day moving average, and they've been pretty solid overall. So watch the consumer staples. That's another area that I've been involved in the last couple of months. So watch them as they pull back a little bit and see if they can rally up there. Again, if the initial jobless claims was legit, and if some of the retailers are saying, yeah, things are tougher and the economy's starting to slow back down again, then watch consumer staples because, again, discretionary should underperform compared to consumer staple type stocks. These are the stocks and the companies that people, of the things they have to have, discretionary are the things that they want. Materials, this is another area I'm involved in, and you can see it's been doing very, very well. Actually was up 0.5% yesterday, so really outperformed a lot of areas yesterday, and it looks like a good entry point for materials. Again, kind of doing this zigzag pattern that, the zigzag pattern that the S&P was doing earlier in the year. Just kind of moved sideways a little bit, and now it's sitting on its 50-day moving average. It's sitting at the bottom end of this trend, so I would look for this to move higher as well. Especially, it kind of goes within that metals and mining and that whole kind of inflation trade. And materials stocks may outperform going forward. All right, I did want to answer a question that I got a few days ago, and basically the person asked. He sent me an article about that companies are doing some financial engineering, and they're not really selling more widgets. They're not grabbing new products, new market share. And so he was saying, does this signal slow growth for the firms in 2014? And so basically we've seen a trend this year companies are buying back stock, boosting dividends, etc. And we have to look at what's happening. Yes, some companies are doing it out of peer pressure. Some companies are doing it because it financially makes sense. If a company can go and issue debt in this low interest rate environment, they can borrow money at a low interest rate, then they can turn around and take that capital. What do they want to do with that capital? They can invest it in R&D. They can go back buy their own stock if they think that's the best way to do that. There's a lot of things they can do with it. What's the return on their money, right? If I told you had a guaranteed earned 15% a year and you could borrow money at 2% a year or 3% a year, wouldn't you do that? Of course you would if you knew that. And so that's what companies have to deal with all the time. So a lot of companies, they know interest rates are going to go up, so they're taking advantage of refinancing their debt or issuing debt to do other things with it. Now, there are those firms that are simply doing that to make their earnings per share go up, and they're not selling widgets. They're not actually growing. So yes, they may be a well-managed company, and they're getting their earnings up, and that's what we're trying to do, is get it to be a more profitable company, but that's not sustainable over time. You have to be selling widgets, otherwise you're simply going to eventually go away. You can't continue to manufacture earnings. But we are seeing, if you looked at a company like MasterCard earlier in the week, they kind of did a 3-for where they said we're gonna split our stock, which was kind of meaningless. Doesn't really matter if they split their stock, but they're going to do a 10-for-1 stock split. Means $800 stock is now $80, but they're also going to increase their dividend by, I think, 87%, something like that. So almost double their dividend, which is low. It's I think their yield right now is 0.3%. It's going to go to 0.6, so it's not a dividend stock per se. But they're going to boost that, and they're going to buy back so many billions of dollars of stock. That's what they're going to do. And what's wrong with that? Nothing is wrong with that. But you still have to look at the top line, and so you have to put the whole puzzle together, then simply say, does this mean companies aren't growing? We've talked about it in the past that over the long run, the market is more sensitive to earnings per share than it is to revenue. So as long as earnings per share are going up for the companies, the stock market tends to react favorably. And what we've seen over the last 3-4 years is earnings per share continue to rise, the stock market continues to go up. So is it a problem? It's a problem for some companies, but overall, I don't think it's a big problem right now. But thanks for the question. If you want to get your question answered, it's carl@eggerscapital.com. I'll answer those for you on the future podcast. Thank you. Appreciate it. Have a great weekend, and we will talk to you soon.